Hi, this is R Sundar. Welcome to question and answer session. Last week was the first session and the response was really very good, and therefore I decided to continue this session every week. Let us straight away go into the question. The first question, Mr. Pankaj Singh, how can I join your workshop? Whenever I check the link for payment, it seems inactive. Well, we opened the registration few weeks before. We have got extremely good number of people who have already subscribed. We need at least 2 to 3 months to clear the backlog. So therefore, we are not opening the registration, because we open the registration, we take the money, then you may have to wait for more than 3 months, and many people will not like to wait for such a long period. I really appreciate the people who have already paid and they are waiting it. And we are adding security features to our videos, and that is one of the reasons our video is getting delayed. So therefore, kindly continue to watch Twitter as well as the YouTube. Whenever we open registration once again, we will announce it in these 2 places. Then you can register. Next question, Mr. Paramesh. Sir, please explain in derivatives options in a particular of time in a particular strike price, buyers are more or writers are more. How to know? Explain in simple way. Thank you, sir. I know from where he is getting this kind of questions. Whenever you watch business channels, they always say, today there was a delivery buying of 500 crore in Reliance. Today there is a delivery selling of 500 crores in HDFC Bank. So they talk like that. Actually, let me tell you, what amount has been bought, the same amount has been sold. Buying and selling is always equal. Then how these business channels are interpreting? If suppose the price is going up, so they think that the buyer is smart. They say 500 crore Reliance has been bought. If the share price is going down, they assume that the seller is smart. Then they say 500 crore delivery selling has happened. So other than that interpretation, actually in any market, forget about the share market, in any market, the selling and buying must be equal. The quantity of selling and the quantity of buying must be equal. Number of seller may be different. Usually in stock market, there may be 100 option buyers, but there may be only 1 option seller selling to all the 100 people. So the number of buyers may be different, but the quantity of buying and the quantity of selling must always be same. So therefore, there is no point in looking at buyers are more or sellers are more. Next question, let us say I sold 1 lot of Nifty put call giving approximate 70,000 margin. What happens if my position goes into more than 70k loss? Will it take more margin automatically? Asking in reference to your year-end position, it may go into loss in short term. Yes, this is a very nice question, but let me explain in detail. Let us say we are playing in futures market. Let us say you are going long in a futures, I am going short in future. If tomorrow market goes up, you make profit, I lose. Let us say you make 10,000 profit, then I lose 10,000. What the exchange do? Today when you go long, I go short, they take margin money from both of us. Let us say you also pay 1 lakh margin money, I also pay 1 lakh margin money. So this 1 lakh margin money, each one of us paid, the exchange keep it. The next day, when you make 10,000 profit, when I lose 10,000, what the exchange do? They take 10,000 from me and they give it to you. So that is called MTM loss for me, and that is called MTM profit for you. This game continues. Let us say the next day, again the share price comes down by 20,000. So you lose 20,000, I gain 20,000. So they take 20,000 from you and they return 20,000 to me. So this is called MTM profit or MTM loss. So this MTM loss or profit keeps going on a day-to-day basis. until we both close the position. When we close the position, exchange returns our margin money. So this is how the future market works. How options market work? It does not work the way futures market work. Let us say you are buyer of an option, I am seller of an option. Today, when you buy the option, you pay the premium money to the exchange. You don't pay the margin money. I pay the margin money, but the premium collected from you is returned to me. Okay, what happens the next day? Let us say next day you make 10,000 rupees profit. So you don't get that 10,000 rupees from the exchange because it is not MTM profit. So you will get your profit only when you close the position. So next day if you make 10,000 profit, the exchange don't give the 10,000 to you, but they take 10,000 from me. Then how do they take 10,000 from me? It's very simple. They increase my margin money by 10,000 rupees. Let us say second day, you gain another 10,000. So again, you don't get any money, but again, exchange will increase the margin money by another 10,000. So like this, as I keep losing the money, every day exchange will keep increasing the margin money. Let us say you lose 10,000 rupees. So that means I gain 10,000 rupees. So in that case, what they do, the exchange reduces my margin money by 10,000. So here the difference is very simple. In futures market, margin is calculated separately. MTM loss or profit is calculated separately. But here in options market, the actual margin is actually the basic margin plus the premium collected. So when the option price goes up, the span margin also goes up. When option prices go down, the span margin also goes down. So this is how it operates. So initially, when I sell a call option, I think approximately the margin works out to be around 80,000 rupees. So the problem will come to the exchange only if I lose 80,000 in one single day. But that probability is very, very low because the margins are calculated by taking the probability of a market not falling below that 99% of the time. I think we don't have to go into all those calculations, but exchange is safe in this way. So please remember, option buyer pay only the premium money, then forget it. An option seller, every day he receives or he pays to the exchange, but not as MTM loss or profit, but span margin keeps increasing or decreasing according to the option prices. Mr. Dinesh Sambandam, inspire us with great job done by yourself to yourself in social media. Also tell us most terrible mistake you have done in social media. One good thing is that I came to the social media. In fact, I did not have a Twitter account at all. One day, one of my students, I was his mathematics teacher when he was studying in 10th standard, and his name is Prashant Tejura. He's a software engineer working in Pune. So he contacted me and he told me, sir, please open a Twitter account. You are in Facebook, but Twitter is more powerful as far as the traders are concerned. So I just jokingly told him, I was your guru when you were a student in school time. Now you have become guru for me in Twitter. And in fact, when I opened my Twitter account and he promoted me, in his timeline, he spoke something good about me, and that is how I got first few thousand followers, and now I have more than 90,000 followers. So this is something very good has happened, and in fact I can say no student would have done such an excellent thing to any teacher what Prashant Tejura has done for me. I do not know whether Prashant Tejura will be watching this video. If you are watching, a big thanks to you, Prashant Tejura. Second thing, what is a terrible mistake? Sometimes we feel coming to social media itself is a terrible mistake. The way the trollers troll you, they ask questions, doubt all your things. But I feel what the biggest mistake I did in the last few weeks, when I announced webinar for charity, I should have announced it's only a webinar. And after I collected, I should have given for charity. Just because I announced it before the event, there were many trollers. They are attributing the success not to my skills. And one troller said, if you are doing a webinar, you will not get even 800 people. Because of charity only, you got 8,700 people. And then there's so many trolling, where is the proof of donation and this and that. I could have avoided all these things if I told you, say very simply that it's a webinar. You want to attend, you attend. You don't want to attend, you don't attend. And after collecting the money, I should have given for donation, so nobody would have questioned. So next time onwards, even when I plan to do webinar for charity, and I will not say that it is for charity, I will just say it is webinar. So nobody can question me. And after that, definitely I will donate all the money. Vishwesh, how markets do opposite of what the crowd thinks? This is the law of nature. In any country, not all people will be rich, only few people. Not all people can be successful, only few people. So the same way, stock market also follows the same rule. So the stock markets are designed in such a way that only minority people can make money. So how minority people can make money? Only when things go against the majority of the opinion. There is a saying in stock market, consensus is dangerous. So many times you would have seen when the whole market, every participant is consensus, market is bullish, the market will crash, right? At the same time, you cannot take the opposite view also. So sometimes it happens like that. Mr. Satish Kashyap, please explain margins required from June. Will it be significantly less compared to now? Next question, which all cars you drive? Next one, what are your passions, sir? Means what interests you more when you are not trading? So he has actually asked 3 questions. Let me answer one by one. So from June 1, if you are selling an option, margin will be still the same. There is no change. But whenever you sell an option, 200, 300 point away, you buy an option, then your position become limited risk strategies. So for those limited risk strategies, the margins are less. In fact, in US markets, for limited risk strategies, the margin is same as your maximum risk. But in India, they are not planning that way. So how they are calculating the margin is very, very complicated one. It's not so easy for you to understand. I can simply tell you, if you are buying a call option 200 point or 300 point away, your margin for Nifty will work out to be 25 to 30,000 rupees. Whereas if you sell a naked call option, your margin is about 80,000 to 90,000. So you can reasonably assume that your margin will be 1/3 of the present margin. Second question, I personally drive Jaguar and Mahindra XUV. And of course, I also drive Benz, BMW, Fortuner, Innova Krista. But those cars do not belong to me. They belong to my extended family. What are your passions? I like to listen to music and I like to watch movies. In my house, I have a very nice home theater system with Dolby Atmos speakers. In fact, earlier once or twice, I posted some photos of my home theater. What is the interest rate for calculating option Greeks? Where can I find it? I really don't know why people want to know everything related to these things. And whether you know everything, you calculate everything. Let us say, for example, okay, the fair value of an option work out to be 50 rupees. But in market, if it is trading at 60 rupees, what can you do? So what price you see in the market, that price only you can buy and sell. I don't think that you should be worrying about all these things. And second thing I tell you, the market price will always take into everything into consideration automatically. Right. But anyway, since you asked me this question, let me answer. You go to nscindia.com, go to live market, option chain, equity derivatives. So this is the option chain. When you look at the option chain, you come to the bottom of the screen and you can see 10% interest rate is applied while computing implied volatility. So therefore, NSE takes 10% as the risk-free return while calculating the implied volatility. So this is where you can see that. Next question, Shreyas Jain. Hello sir, how to keep us motivated for further trading if sometimes our trade goes in loss? Your journey from small trader to trading with big HNIs, what keeps you motivating? So it's very simple. Before taking a trade, you make sure you know what is the risk and what is the reward. And I always say, to be successful in options market, you need to have an edge, you need to have an hedge. So once you start making profits, and automatically the motivation will come. So once you lose, you analyze why you have lost it, and if you have made any mistakes, don't make the mistake again. Next question, Sudha. Sir, how option price is determined finally on the expiry time? Option price with spot price, both are differentiate and final at 3:30 p.m. expiry day or anything else. Could you explain? Yes, this is a very nice question. Let us say somebody has bought 9,000 put option and on expiry day, the market closes at 8,990. So 9,000 put option he has bought, the market closed at 8,990, which means that his intrinsic value is 10 rupees. So he is expecting he should get 10 rupees. But sometime that option will not be closing at 10 rupees, that will be closing at 0 rupees. So the people ask, sir, how come the intrinsic value is 10 rupees? How I am getting 0? So that is because the market closes at 8,990 only at 3:30 on the expiry day. But the closing price for options is not the last traded price. The closing price is the last half an hour weighted average price. So let us say in the last half an hour, the market has fallen from 9,010 to 8,990. Assuming that same frequency of trade is happening. If the market falls 20 points, the average will become 10 points. So that means when the Nifty falls from 9,010 to 8,990, the average becomes 9,000. So last traded price may be 8,990, but closing price is 9,000. Because closing price is 9,000, your 9,000 put option will be having 0 value. So because of this, the prices of options are different from the intrinsic value. I hope I have answered enough number of questions, and the remaining questions we will answer next week. Thank you.